This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more. Welcome back to the Commercial Real Estate Investor Podcast. We are live with another round of the Brokerage Roundtable, and we're going to be diving into what is going on in 2025. What is everybody's outlooks on where brokerage will be, considering the new year is pretty much upon us. The Urban Land Institute has released their Emerging Trends in Real Estate report, and I figured now's probably a good time, as good a time as ever, for us to dive into what's everybody's outlook on 2025? What are your projections as to what's going to happen? How is technology going to impact what we're doing in our day-to-day lives as commercial real estate brokers? Chad, I'm going to kick it off with you first, man. I mean, coming in on the industrial side, what do you think 2025 is going to look like in terms of transaction volume? And how will that compare to recent years? And what might be driving those changes? Because industrial's kind of been the darling, right?
Yeah, it's a great question. And I would say as a general answer, I think it's going to be similar to how 2024 is shaped up. And I say that because I think the main catalyst for transactions right now is a change in interest rates. And we saw that. We saw that in 2022 when interest rates started going up, transaction volume dropped. And I'm anticipating that interest rates are going to be the same in 2025 as they are now, solely on the basis that I don't think inflation is anywhere near under control. And if they were to lower interest rates further, I could see that causing pandemonium in the market where everybody would just be super bullish on the economy. So I think solely based on the outlook that I think interest rates are going to be steady for 2025. That's why I think transaction volume will be consistent. But if we do see an interest rate drop, I think we'll see a flurry of activity.
Yeah, it's pretty interesting to see interest rates starting to drop. We just had another quarter point drop pretty much within the past week. And that always sparks a lot of interest in the commercial real estate market, considering how much leverage is used in these deals. But I heard an interesting thing I went to the Emerging Trends in Real Estate breakfast this morning in Nashville, and the representative there from PwC was like, there are pros and cons to lowering interest rates, right? She was like, lower interest rates don't necessarily mean that the market is strong. It could actually mean that the market is pretty soft, and there's some other issues that we need to pay attention to. So I was like, wow, that's an interesting take, because we almost always hear in commercial real estate, lower interest rates, better deals. But that could mean that there's some issues in the economy. Jesse, with everything that's going on in the office market, man, I mean, there's some lingering challenges, but I also think there's some interesting types of office that have taken off. What are your predictions for office transaction volumes in 2025? What are we going to see in that market?
I think we still have a lot of distressed assets kind of going through the process right now in terms of writing down book values. I think that the B and C class office buildings are going to be challenged in most major markets. In terms of leasing volume, from what we see, leasing volume is starting to kind of bottom out in terms of where we've seen the pricing at. I know in our market, 2025 seems to be kind of the rebound year or the baseline year from all the indications that we look at. So I do think that we've finally come to, a realization of how much people are going to be using office. Maybe that's 3 or 4 times a week. And I think a lot of companies have calibrated how much office space they need as a result of that. But I mean, there's some interesting things that I think are going to continue to go on. I think that, office to residential conversions where they make sense, we could see that continuing. I know in a lot of markets now that had mandates or requirements for office replacement when you were doing residential or other projects, I'm starting to see some markets that are easing that just because the demand is not as big as it was prior to this. But yeah, I still think it's kind of bit of a year in flux, and just trying to get our bearings to see what exactly we need going forward. I think we all know that there's been definitely a shift in the office market, and I think we're starting to finally see where the dust is settling there.
Yeah, it's interesting. We heard this morning that across the United States, the amount of office buildings that are actually ideal for office to residential conversions is 2.7%, right? A
Yeah, it's
much,
very low.
much lower number. A much lower number than everybody thinks, right? Everybody's like, oh, just convert it into residential. Well, it's not that easy. And in fact, it also is market dependent on the type of office that you're developing. Nashville specifically, around 1% of office space made sense to be converted into residential. So you're probably not going to see a whole lot of that. So interesting
Yeah,
things
I
to
think
keep in mind.
pricing is really where we're starting to see kind of the craziness of 2018, 2019. We're starting to see that come down. And I mean, it's such a tired phrase, but there is the flight to quality or flight to amenities that we're seeing. The A-class, triple A trophy assets in our market, and I know in a lot of U.S. major markets, they really have not been affected in the same way that tertiary and even suburban markets have been affected from a vacancy standpoint. So we are seeing people move towards those upper end of the office world.
Yeah, it's interesting how much more advanced today's new construction office space is compared to even 5-10 years ago. I mean, it seems like office that was built 5 years ago is now obsolete, which is kind of wild to say, right? But that's
Yeah.
just how quickly the office market has changed. Adam, let's get to you on the retail side, man. I mean, what are your predictions in 25 for the retail market? What will transaction volume look like? What are retail sales and consumer activity? What's that going to look like?
Really different questions. I mean, I think the sales activity from like a sales per square foot is changing. You're starting to see a little bit of softening in the luxury markets. People aren't just like spending money like it just doesn't matter anymore, like the Gucci's and the Louis Vuittons of the world, people like that. Although they're still growing, I just think that there's not this like runaway, there's not the wraparound lines at the Louis Vuitton store like it was 6 months ago. So I think luxury, you're starting to see a little bit of softening, but actual like lease volume and just transaction volume is kind of being hampered by no new product, right? There's just not a lot of new development. Retail it's kind of harder to hit the streets with because it's so location specific. Industrial, at least you can kind of just go a little bit further out, right, and build a really good industrial park. Whereas retail, you've got to be kind of on these main corridors. And I think the flight to quality comment was very true, right? Like the people in committee are being a little bit more careful with approving new deals. Like instead of doing 10 deals, they're going to do 4 really good deals. So I think that the volume will kind of continue to be what it's been the last 18 to 24 months, and until there is more investment on new ground up construction, there's just going to be a natural constraint on new product in my world.
Yeah, it's really interesting to see how little new construction retail is going on. I mean, Nashville is at an unbelievable market low in terms of vacancy rates because there's just nothing there. I mean, a lot of the deals, and I'm sure you're experiencing this in Charlotte, a lot of the deals that my guys are having to work on the brokerage side are off market. We're having to get a hold of these, I mean, it's going direct to a tenant that's maybe a struggling restaurant that nobody knows about. So you're calling every restaurant you can get your hands on to just figure out, hey, how are you guys doing? It's tough work right now, man. I mean, I always find it funny when people see like the commercial real estate market and it's, doing well in the headlines. But I'm like, man, all of my brokerage friends, all of my investor friends, we're all tired of it because it's so much work to get the same deal done. If you are joining us live, question of the day, what do you think will be the biggest driver of commercial real estate transaction growth in 2025? Better financing, market clarity, or tenant demand? What are your thoughts? Maybe you've got another one. Let me know in the comments Let's talk about it. Also, I've got a fire question for you guys real quick. We'll start it off with Chad. This one comes in from Doug. Which asset class will perform the best in 2025? Industrial? Question mark, question mark?
I like Doug already. I'm certainly biased. I guess I would look at it. If you look at office, retail, industrial, multifamily as being the four to look at. Retail, and Jesse and Adam can correct me if I'm wrong on both these assessments, but I think retail is going to be relatively flat right now. There might be some growth, but I don't see a ton of it. Office, I think, is still going to continue struggling into next year until people just figure out what their requirements look like. I think industrial is going to still have top line revenue growth. It's going to be offset somewhat by property taxes, which are spiraling out of control in virtually every city, and every city seems to be using industrial as their poster boy for trying to get that growth out of. So I think that's going to hurt. I think insurance is going to hurt across the board, but I would still be bullish on top line rent growth for industrial. And multifamily, I think that's going to be a little stagnant too. It just went up so much so fast that people are trying to adjust and calibrate. But I'm also laser focused on industrial, so I'm kind of speculating as an outsider, trying to look at those asset classes. I'm just, all I do is industrial, so I'd leave it to those guys to give their commentary on why I may be wrong. But I like Doug. I'm long industrial.
Jesse, what are your thoughts?
Yeah, it's a good question. I don't know. I'm pretty bullish on student housing and old age communities, depending on the area. I think it's just a cohort that's going to need more. I might be biased on that from the student rental standpoint in Canada because we have rent destabilization or rent control in almost every province, or some version of it in almost every province. What's nice about student rentals is we get around that because you get a new cohort every 3-4 years. So if purchased at the right price, it's a asset class that I think is going to continue to be continue to be powerful in our markets.
That's really interesting. We'll have to do a deep dive sometime on student housing in Canada, because I didn't realize that was such an interesting opportunity up there. Adam, what are your thoughts, man?
Well, I mean, I'll just do the same Homer type view that Chad did, and just talk about retail, right? So I think what's interesting that is being driven by what I mentioned earlier, the difficulty or inability to just put more, retail square footage on the ground. I think the real opportunity is, wearing out shoe leather and finding kind of mom and pop guys that own 4 or 5 shopping centers that their grandfather built or their dad assembled, and go in and take more of a capital markets or quasi-institutional approach to running those. Because a lot of those opportunities were, hey, I'll get you in for no money. I just want you to pay your rent. The rent is kind of really reasonable, where if you come in and really spend some money on the property, make it beautiful, make it accessible, make the signage great, upgrade the infrastructure, you can get it to a more market rent rate. So I think that there's still a lot of opportunity to do that, and it's being really brought to the forefront because retail is kind of a sexy asset class right now, and it's just really hard. I mean, you're buying the stuff when you can't really replace it with other things. So that's something that I want to do more of this year.
Yeah, I think the thing to keep in mind too is it's so hyper market specific. Like you can't blanket coat anything, because what was interesting is like hearing from PwC this morning, nationally across the United States, industrial is the number 1 property type to keep an eye on, right? But it's 3rd in Nashville. Like Nashville has almost been overbuilt, at least for the foreseeable future. Not like in such a devastating way that we'll never be able to catch up. We've just built a lot of industrial. Number 1 is retail. Number 2 is single family rentals, right? That's interesting to think about. Like it really does depend on the market and where
you guys' tourism throws off everything. I mean, you guys have like that tourism engine that's just going at 10,000 RPMs, 12 months out of the year. So It really does just totally skew, and that makes total sense, right? Retail and single family for rent makes a ton of sense in that market.
That's right. Yeah, and hey, we can't figure it out, right? We don't have enough hotel rooms. The Airbnbs piss everybody off. It's interesting. Chad, let's get into technology, man, because I mean, one thing that we've really seen over the past couple of years is, I mean, commercial real estate in many ways is taking some massive leaps forward in terms of technology utilization within the industry. Because I used to always say, like, the commercial real estate stuck in the 1980s. And now, if you're not utilizing AI in some sort of aspect in your business, I feel like you're already behind in the brokerage world. What data driven tools or what tools in general are you seeing in the industrial world that are helping y'all stay competitive?
Yeah, great question. And I think the biggest thing that I'm using AI for right now actually combines all the data that's out there because there is so much out there. And 10 years ago, we always had a data problem of data overload, but it's growing exponentially. There's so many companies out there that are providing data and insights and market reports and commentary and insights and everything you can think of that it really is much more overwhelming than it was even a few years ago. So what I use AI for quite often is just to get a summary of a report or of a news article. So I've stopped watching mainstream media for the most part 5 years ago. I don't watch any news. The only thing that I subscribe to is Wall Street Journal, which is also getting a little bit wonky lately. But I subscribe to a number of different magazines and trade publications like Globe Street and Biz Now and The Real Deal, like some of those ones that are very focused on the industry. But even that, it can be inundating having that much information hitting you all the time. But if you put an article into ChatGPT and just ask for a summary, a one paragraph summary, it'll give you those cool notes. So I could now go through and read 20, 30 articles a week or market reports, but it's very condensed. So I found that to be a very efficient way of just staying on top of things. And it goes to your point as well. You do have to keep on top of this because now that we've got a new presidency, we're going to see more change in the next year than we've seen in the last 4 years, probably combined. So I think everyone's going to have to stay on top of all this macroeconomic data. It's going to be really important to stay on top of micro data, and if I can just take one more quick minute here without, and cut me off if I ramble, but I think you mentioned Nashville is the industrial is the third biggest category. I think that's going to be emblematic across a number of different markets. There's going to be markets that win, there's going to be markets that lose, but there's also going to be subsections of different asset classes that win in some of those other markets. And I look at Dallas as an example. I think Dallas is going to continue doing really well, but they've heavily overbuilt on their warehouse space. So for big box distribution, they're going to have a problem getting all that absorbed and chewing through all that space. Whereas some of the port markets that have very low vacancy rates anyways, they're probably still going to do quite well. So I think it's going to be incumbent on anybody in the space, whether you're a owner, user, a tenant, or a broker. You've got to be up to speed on every single thing that's happening in your market, but also differentiate between a 200,000 square foot warehouse space and a 10,000 square foot industrial outdoor storage space, because those are two completely different things, even if they happen to get grouped under an industrial vacancy rate. So if you see like a report in Nashville or Charlotte or Toronto and it says industrial vacancy rate is 5%, well, is that 5% for the 200,000 square foot warehouse, or is it for the 10,000 square foot spot on 2 acres? So I think people are going to have to get really granular, and AI is going to be a great tool for that. That's where the opportunity is going to be in my mind for tech savvy people to be able to interpret and narrow down and be laser focused on the exact type of data they want instead of just having a bunch of high level noise.
Yeah, it really helps you, peek through the clouds, so to speak, right? As you're going through that process. Jesse, talk to us about what office brokers are seeing, either in terms of office brokerage or what your tenants are doing. Now that we've got hybrid work needs for tenants, sometimes I mean we're seeing a lot of companies not necessarily abandoning office space altogether, but they're reformatting hey, maybe we only need half as much space, or we're having some, workers come in on different days. What kind of technology are you seeing to address kind of the hybrid work needs?
Yeah. First of all, I can definitely vouch with Chad on summarization of articles. It's a great tool.
There's a
It
lot
turns
of
out there's
fluff.
a lot of fluff. Yeah, so for us, there's a number of different things that we've been seeing from a tech standpoint with offices. This is stuff that has existed for a while. I think it's getting better. Smart scheduling when it's coming to hoteling. We're starting to see even in a relatively new office that we've moved into, senior staff is, less reluctant than they have in the past to sit on the floor to schedule different seating arrangements. We're starting to see, continuing to see more we space than me space, so collaborative kind of work areas. And yeah, I think you're right. The actual space needs for a lot of companies have come down because they're getting more efficient and they're being a little bit more careful of what exactly they need for their workers. But I've always, the senior guy I trained under, he always gave me kind of this chart that has an exponential curve of how companies grow, and then something that looks right behind it like stairs. And that's really the real estate or the stairs that you're trying to map, because you hit a wall, then you got to get more space. You hit a wall and you have to get more space. So we have yet to create the continuous office that, slowly adjusts to every kind of move that your company makes as it grows and shrinks. And so for us, it's always going to be a bit of trying to map on the right office space to the growth that you have as a company. So as long as that is a reality, I do think, if you're still in the office 3-4 days a week, you need office space. That's kind of the bottom line. Now we do have solutions. Co-working continues to do well in our markets. Where you get some flexible offices that are kind of the same idea as co-working, but maybe under a different name. We're seeing that as well. But I do think just utilization, trying to get more specific on what companies need. I think that's kind of the trend that we're seeing more so, and I think that technology will be there to assist that. And the last thing I'll say is hopefully, we don't make the mistake we've been making in the last 30, 40 years in commercial real estate and have the residential guys just light years ahead of us on this stuff.
Yeah, they typically are. Dude, real quick, back to you, Jesse, again. I mean, there's this software that I've seen where you can drop a floor plan into it, and it'll start giving you all sorts of different ways to lay out the floor plan to maximize, open workspace versus, closed offices. Are y'all using that now to present to clients to say, hey, by the way, if you guys do start to outgrow this space, here's some ways that we can see you fitting more employees into this for like temporarily?
Yeah, I can't remember the name of the company, but similar to like what we've done in the past, where we would give like a high density, a medium density, and then a low density floor plan. We're starting to see ones that are actually evolving based on how you toggle the employee count. So if you want to be, say, 120 square feet per employee, now you've gained, say, X amount of employees, you toggle that, and then you can see layout slowly changing. So stuff like that, I think, is only going to make things better. Another kind of interesting one, a little bit off topic with this, but even AI, where subtenants, for instance, they're not in the business of sublandlords are not in the business of really evaluating tenants. So they often come to us and say, do these financials look good? And not, obviously privacy issues, are going to be a chief concern, but we're starting to see different software like ChatGPT where you can say, listen, I want you to look at the credit worthiness of this company based on their financials. I want you to make a focus on cash on hand, quick ratios, and then it can give you an evaluation. And I think we're going to start seeing more self-serve tools like that in the financial and the legal world that pertain to real estate.
Interesting. That'd be really cool to see. Adam, the retail world has shifted quite a bit. I feel like a lot of tech is focused on what's going on in the retail world. I mean, you're seeing a lot of these softwares pop up that really bring in, granular foot traffic analytics, right? Mm-hmm. I mean, how is software kind of reshaping the way that y'all do retail real estate?
Well, it's almost changed the DNA of retail. I mean, the new companies, and this happens in every industry, but like the new kids on the block that were kind of born online, the digitally native companies completely transformed the way people use data and analytics and have led to all these new innovations. So, the groups that are born online, Warby Parker is kind of the most famous example, but there's dozens and dozens of these guys. They go in, they know where every single one of their customer lives, works, plays. They're buying all the cell phone data, they're buying all the geolocation data. So groups like Placer AI and that data and technology has just completely transformed the way that we analyze sites. And it used to be as simple as like traffic counts and, just really basic, and demographics, obviously, right? Demographics are still kind of the holy grail, but it's changed from that to like psychographics. And then it's changed from that to, rankings of every single retailer within a mile radius and graphing it out to kind of build a really, really specific picture of who the buyer is and is your buyer on site and do they transact here. So the Placer AIs of the world and those groups, in addition to the in-house data that all these digitally native companies use, has completely transformed retail. Like and not just with the Warby Parkers of the world. Right now, you have the Buxtons and all of the big mapping software guys that are coming out and giving retailers the ability to just get insanely detailed with the way they look at sites. So there's no going back. Like I was even with, we do a lot of work with Ace Hardware, which is not considered the next Warby Parker of the world, right? They're not considered, this like futuristic group, and the data that they use, tied in with heat maps and the Placer AI data, is light years ahead of even what a more sophisticated user, like think about a big growth user from 10 or 12 years ago, like an Outback Steakhouse. I know everybody make fun of the Bloomin' Onion, but they opened a shitload of stores, right? And these guys were freaking blowing and going. The data that even a more standard group uses now is completely different than what you would have used 10 or 15 years ago.
Hey, man, the blooming onion has to be one of the greatest appetizers of all time, because here we are,
Good day, mate.
like 20 years later, still talking about it.
Still doing it.
I mean, well done,
They're still
Outback.
opening stores. I mean,
Yeah. That's great. We got some great questions in the live chat. I want to make sure that we get to these. So let's dive into that. So Van is saying, please, if possible, speak to job security and availability for those doing a real estate master's throughout 2025 and looking for work in 2026. What should we focus on throughout 25 in preparation for the next year? Chad, I'm gonna start that off with you. If somebody's going through getting their real estate master's, what could they be doing this year to prepare for the job search next year?
Yeah, I'll give you two actionable things that I would be doing right now for you. And the first is get to know as many people as you can. So try to connect with brokers, try to connect with property owners, try to connect with anybody that is involved in the real estate business, and just ask them if you could grab a 10-15 minute coffee with them and give them something of value. I think that'll increase your chances of having them say yes. Perhaps if you're working on your master's and you're working on a project, you could go and say, I'd like to have 10-15 minutes of your time in exchange for that. I'll share with you this report that I worked on that explains something in the business which I think will be of interest to you. I think that gives you a pretty good chance of getting to meet a lot of people. And I know all three of you guys will agree with this as well. The real estate community is awesome. If you're polite and you're diligent and you're following up with people, there's a very good chance that someone's going to say yes to meet with you. So go to their office, get to know as many people as you can, and you'll find a job if you're effective just by doing that. Second thing that I would do is become an expert in your local market. And I know I've kind of talked on that a little bit, but start studying it already. Start seeing what listings are available. Start seeing what properties have sold. Start seeing market trends on vacancy rates and absorption, and really actually understand the market. Because if you're going the academic road of learning everything you can about the finance side, which will probably be heavily focused on, your blind spot is actually knowing the market. So you'll be trying to get a job with someone and you won't really understand what's going on in the market beyond beyond having a really good education and a good sense of what's happening from a financial standpoint. But if all of a sudden you combine that with knowing a bunch of people out of the gate and you have a solid understanding of what the market is, man, you're unstoppable.
You
That's
don't need any
killer.
more advice than that. That's perfect
Yeah.
advice.
I was gonna
That's
say
perfect.
we're not even gonna send that one around. That was perfect. But I agree with that, man. I mean, if you are working on your real estate masters and you reach out to me and you're like, hey, I have something interesting I want to share with you. I'm like, hell yeah, let's grab coffee. I want to hear. It's like, I think that stuff's interesting. Jesse, let's throw this one over to you. This is from Derek. You say, good evening, all. When you're looking for tax accounting, legal, and your investment team, did you look locally, regionally, or nationally? And feel free to elaborate why.
Yeah, so it kind of followed the investments that we made initially. So my partner and I, locally, we started making those investments. Once we started putting more properties in the corporation that were regional, then we started kind of looking at a company that could handle something larger. I will say this, legal and taxes and accounting, you kind of take in the chin for the first little while until you get up to scale in terms of the expense as a percentage of your income. So until you get up to multi-units, it's unfortunately it's just a large component of, or it's a large expense, and it's not one that you really want to skimp on. But I would try to do your best to try to save as much as possible when you're dealing with only a couple rental properties. But yeah, that's how it's gone. I'm not at the stage yet where I need a national team. It would be great if we're there. But yeah, I think there's a lot of good local teams, and then just figure out exactly what you need. If it's only a property or two, you might not need monthly bookkeeping. If it's 10, 15 properties, it's a different story. So yeah, I would go with people that in your area that specifically deal with real estate, because as I'm sure there's a lot of nuances that come with any area when it comes to accounting and taxes.
Excellent. And guys, I know we're 2 minutes past the hour. If y'all have to jump, you got to jump. But we've got a couple more questions. I'll make sure these get knocked out. Samuel, actually, Chad, I mean, if I can throw this one to you. Samuel saying, good afternoon. What are you guys going to most look at when it comes to finding good lenders? Is it the loan to value, the origination fee? Would appreciate all the insights from 4 sides of this call. Well, unfortunately, Adam jumped off, so you can at least get 3. Chad, we'll start with you, man.
Yeah, there's a lot that goes into it, and I've bought properties now for the last 10 years, and I've refinanced, I've sold, and I've renewed debt. So this is topical for me. I think that you got to weigh everything, and ideally you want to talk to a few different lenders. If you just go to one lender, you're getting their rate and you're getting their terms, and it's really hard to actually compare apples to apples if you don't know what all the apples are. So I think the break fee is important. I think what the interest rate is naturally important. What they require for credit risk. We had one loan, my partners and I, and we just renewed that loan in the summer here. And we originally had a corporate guarantee and we had personal guarantees on it. And we were able to discharge the corporate guarantee on the renewal, and on the next one we're going to be able to discharge the personal guarantees, at least hopefully. So I mean, that's a big deal. You might be able to get a better interest rate somewhere else, but if you've got your personal guarantee on there for the duration of the lease or duration of the mortgage, that could be a problem. So I think you really got to understand exactly what you're getting and compare it to other lenders, and then at least you can make an educated decision.
Yeah, I like that because it's not always black and white, right? I mean, sometimes it's worth paying a higher interest rate to not have it tying up a space on your balance sheet where you could go buy another property, right? Jesse, what are your thoughts?
Yeah, I mean, I think Chad said everything pertinent there. The other thing too is like we've shopped stuff around on our own. Sometimes it's beneficial to have a broker that's in the lending world to do that for you, and actually, they'll look at a host of different lenders. But I definitely think, yeah, there'll be what is it, penny wise, pound foolish. Personal guarantees are kind of the kiss of death in a lot of ways, because they get a deal done, but you don't see the potential risk down the line that they could expose yourself to when they could have been maybe dealt with by going with a different lender. So definitely those type of things. But ultimately, LTV is going to be, if you're good at underwriting deals and you get good at underwriting your own deals, if it's not your lender, or it shouldn't be your lender that is the training wheels for you to take on risk, right? You should be underwriting to what your philosophy is. If it's conservative, if it's more risky. And then the last thing a lot of people don't talk about till the end is look at the fees, man. Like people at the end of the day, when a building closes, even to this point, after doing this for, 15 years, I'm still amazed at all the fees that kind of get totaled up at the end. So keep an eye on those as well.
Yep, I couldn't agree more. Let's see here. Game Master is saying, I would say better financing is going to be the biggest driver of commercial real estate transactions in 25. Aren't a lot of the loans going to be called in 2025 and 2026? Yes, I believe that they will, because if you think about it, most commercial real estate loans are on a 5-year term. What was 5 years before 2025? 2020 and 2021. Those are loans that are going to have incredibly low interest rates. You're going to have very different terms. So coming into today's market, night and day difference. A lot of those may not be able to refinance. So now is when we could actually start seeing some shakeups. Justin is saying, guys, check out the AI platform called Giraffe Build that assists in site development and planning layout, yield analysis, and zoning. I actually did pull that site up while Jesse was talking to look at it real quick. It looks interesting. It seems to me like it's going to be a difficult thing for it to do that on a local basis, but y'all check out giraffe.build. Let me know what your thoughts are. Gentlemen, appreciate you joining me as always. I'll see you here in a couple of weeks, and we'll see y'all in the next one.
Cheers, guys.
See you.
This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more.